Good morning, everybody. This is Dennis Wilborn with the Active Trend Traders. Welcome to the How to Make Money Trading Stocks for July 1st, 2016. Joining us today from Dallas, Texas, of course, is Mike Traeger. Mike, how you doing this morning?
Hello, just indoors where it's air conditioned.
And well, I'm sitting here enjoying the trade winds a little bit, and it's a very nice day. So far, we've been no big rain or no big humidity issues going on over here. And Michael Bischoff is off on vacation again. I tell you, that guy takes more vacations of anybody I've ever seen. But he's
well, you know, it's summertime in Europe, and they're really big on their off.
Yep, their holidays are very important to them. And so I want to remind everybody that all the materials that we will be presenting today are for training purposes and informational purposes. Traders should always paper trade any new method prior to the risk of their own personal capital. If Mike was with us, you could, this is his disclaimer. And so I want to remind everybody that with the Active Trend Traders, I put a lot of emphasis on training. Mike, you were there for training on Wednesday night. I thought it went really well, and it was pretty good.
Well, good. Thank you. I'll take that as a compliment.
And yeah, because we covered a lot of stuff, but covered some very valuable stuff also. And next week we're going to be talking about selling option premium for profits. If we get some volatility returning to the market over the next several weeks, it turns into a seller's paradise rather than a buyer of option paradise. And so we want to kind of know how to do that. Of course, you know that with our strategy number 3, that is all about selling option premium against a standing long position. And that's been doing quite well this week. Scott, Hawaii is treating us exceptionally well. It's nice to be back home. I will be back on the mainland, though, at the end of July, going to Bakersfield for my sister-in-law's wedding, and then my wife and I are going to drive around the countryside, drive around the United States for about a month, and then back to the Bay Area for the September BAM meeting, and also hopefully the October BAM meeting before, and then by that time our cat should be ready to be transported over to Hawaii without going through the quarantine process, which is really a bad thing, because they quarantine animals over here unless they have a certain level of shots and all that kind of stuff, but it takes a certain period of time for the shots to take effect. So I'll not bore you anymore with those information. So Mike,
Yes, sir.
Did Brexit really not even matter? I look at the market today and there is little fear. The volatility is down low. And then, the second thing is, with all the economic instability around the world, and we got to the place kind of like we were towards the middle of last year, when we kept scratching our head and going, why in the heck is the U.S. market not correcting? Is that the U.S. market, is it really primarily the only game in town? And so that's why we're continuing to see people put money into the U.S. market, even though, from an economic standpoint, it depends on how you look at the U.S. economy. Some look at it and say it's half full, and the others look at it half empty, and some of us look at it and say, what the heck are you talking about? So what do you think?
Well, I think what we have found out this week is, as if we didn't find it out before, and I think it's been pretty common knowledge for a while, but, the global central banks have just really, in my mind, made it really obvious this week that their reason for existence is keeping the stock markets propped up.
Yeah.
If you recall, after this huge sell-off on Monday and Tuesday with, the British referendum, Tuesday morning, the Draghi, the head of the European Central Bank, steps up to a microphone and says, this calls for a coordinated, global, a coordinated effort among, all of the global central banks to take action.
Yeah, yeah, very interesting.
And sure enough, within a matter of 24 to 48 hours, the Bank of England, the Federal Reserve, the European Central Bank all come out and they say, whether they've actually put or done it or not, but at this point, all it really takes is for them to say they're going to do it. We're going to be providing hundreds of billions of dollars in liquidity to prevent the financial markets from becoming chaotic. And and with those statements, look what's happened here the last.
Oh yeah, over the last few days, a couple of.
Yeah.
It's one of those things where, I mean, we know that the Fed, and I'm just going to come out and say it, no more beating around the bush. The Fed is going to do everything they can to underpin this market so that Hillary Clinton gets elected. I mean, that's their objective. David asked a question, if the central banks continue to prop up the market, in his mind, this isn't going to end well. And David, I have to agree with you. The thing about it is, though, is at this point that information is not tradable, so we have to be very careful with that information, that it doesn't keep us from getting, going ahead and executing a trading plan.
Yeah. We've been saying, and we're not the only ones, a lot of people have been saying, for a couple of years now, that this is not going to end well.
Yeah.
And I absolutely agree that it's not going to end well, but it's been going on for a very long time, and the longer it goes on, and the worse it gets to the upside in terms of valuations, the less well it will end eventually. I mean, the hypocrisy coming out of the central bankers is just so glaringly obvious. I just, I've used the word credibility before, or lack of credibility on the part of Janet Yellen and the Federal Reserve, but the hypocrisy they're displaying is just a credibility killer. But in the meantime, they are accomplishing their purpose.
Yeah, they are. I mean, even if it's just talking the market back up, they're achieving their purpose. A couple other questions. One, Barry asked regarding selling options, do you hedge with an offsetting position? The answer to that question is yes, we do, Barry. Secondly, Scott ask a question. Who says it has to end? Maybe this goes on forever. And
it depends on what your definition of forever is.
Yeah.
So,
forever.
History, is littered with, examples of financial bubbles that have burst where, during the formation of the bubble and the expansion of the bubble, everybody said the exact same thing. This is going to go on forever, and, isn't it great? And then at some point, it doesn't go on forever.
Yeah.
Yeah. And that's just history, and this will turn out the same way. The only question will become, as we've been saying for a while, when's it going to happen, and how bad is it going to get, and how long is it going to take to play out? Those are the unknowns.
Yeah, well, a couple of things that people can look at is, one is, while there's a lot of people talking about, that this is not sustainable and not sustainable, at the same time, I'm kind of looking for that camp, that camp to go quiet, and once it goes quiet and they start saying, we got to get on board because, everything's going, and everything will grow quiet without any, dissenters to the centralized planning and all that kind of stuff, and just about the time where when the final dissenter throws in the towel is probably when we hit the end. Scott makes a couple other, if they're accomplishing their purpose, then why don't they have credibility? And And Gary says, does price movement, price movement will tell what's going on. And that's where we just, that's all we can do. And whoever, Christine Romer, said that there was no choice but for the Fed to take the action it needed to. As far as unwinding, there is no set time since it's all bonds, and they can't roll out what? Roll out, and it stops there. Since they can, they can be rolled out. Looking up at the SPX for the week. Okay, straight up off the swing low, which was on Monday. Technically speaking, a straight up off the bottom move cannot be sustained. So is it sustainable, or is this a setup? Saying the same thing about the NASDAQ. The Russell is moving with a little less vigor than the other indexes, and so I'm kind of letting that be my gauge of what might be dragging on the market. And then the big question, will July be weak or strong? In the past, 7 out of the last 10 years, mid part of July was when the markets basically did a pretty healthy sell-off that set up for actually excellent moves going into the late August to first part of October time frame. And so will July be weak or strong? The markets do not have, we have to remember, the markets don't have to make sense. The markets do not have to make sense. The thing about it is we just need to be positioned and recognize when we can start, jumping onto things. And just, while the market's in this kind of environment or in this current condition, is just to recognize that the trading will be short and sweet, very quick. And so Gary asked questions, if the Russell is a leading indicator, then can we position ourselves based on that? Gary, and I'll let Mike jump in on this too. In a normal market environment, I would say yes. However, if you look back in 2015, where the Russell was extremely weak compared to the other indexes, it was those few stocks in the weighted indexes that kept those moving higher, even though the Russell was flat to down for the year and not showing very much life at all. And so that's anything on that, Mike?
Well, traditionally the Russell is considered to be slightly leading for the other equity indexes, and that is often the case, but not always. And nothing's 100%. I think it's best to use that as an indication of maybe what to look for in the other indexes, but not to trade, say, the S&P off of what you see happening on the Russell chart.
Yeah. And so Scott makes a couple of other points here that he said we take the market as it is, not as we want it. So given the fact that the Fed is backing this up, backing what's going on, why are we fighting it? We should be bullish until we are convinced the Fed is going to fail.
That's a really good point. And the only thing I take exception to there is why are we fighting it? Because I don't believe that we as a group on this webcast are fighting it. I mean, I don't see anybody trying to seriously short this market and getting burned that way. I look at most of what we're doing right now just as commentary, but not actionable commentary.
Yep. And so, yeah, matter of fact, we actually traded the market long this week, did we not, Mike?
Yes, we did, to varying degrees of success, depending on one's level of patience.
Yes. And so we always like to take a look at the percentage stocks above the 20-day moving average. Again, this is based on primarily the Russell or the NYSE, which is a non-weighted index. Earlier this week, when we were hitting, this is Monday, when we were hitting down here, a standby alert on the early warning alerts was issued, and also we said if you're an aggressive trader, go ahead and you can nibble right here. And as you can see, as this blasted out of here to now that we went from less than 15% above the 20-day moving average to pushing up to 57, almost 60% over the 20-day moving average. It tells us a couple of things. One is that the 20-day moving average was very close to many of the stocks, and so over the past little bit, it didn't dip. Many of the stocks didn't dip below the 20-day very much. Starts running up, but we're starting to get into a level of resistance up here about the 60 level, and I'm looking for it to, Mike, what I'm looking for is to see if we do in fact start to have a divergence in that on the non-weighted indexes, as we were saying earlier, on the Russell. If the Russell starts to show up weak and actually starts to fall before the other two indexes, we would anticipate if the participation rate in a rally is less than 50%, then I think we need to be aware of that and to see what that may lead to. What we've seen in both the S&P and the NASDAQ primarily over the past year or so is they continue to build up their head of steam until they blew it off, and they blew it off then really, really quickly. Even IBD was talking about this yesterday evening, Mike. They were talking about how this kind of a flash crash type of event. They say they don't happen very often, and also they were talking about how they mark the market back in an uptrend after basically a 3-day follow through, and they again said that doesn't happen very often, but then they refer back to, well, it doesn't happen very often, but it just happened last, and I can't remember if it was October or December, where they, got that, and then 2 weeks later, the market went into a significant correction, not back to a bear market or anything, and so when things start happening in the market that don't happen very often, but they start happening more often, or in close proximity to each other, to me that tells us we're not typically in normal market times.
You're just figuring that out?
Well, I mean, it gives validation to that kind of perspective.
I have a couple of comments on this chart which I think are salient, and one of them is, again, we focus on divergences a lot. So what's happened here the last few days? We've got the market, the S&P, I'm just talking about the S&P right now, the S&P coming up to, practically the same price level it was at in early June and before this Brexit crash.
Right.
Right back up into that 2100, 2110 level. I mean, we got there today. Yeah. We're pulling down a little bit, possibly putting in a shooting star for the daily candlestick. But you see, at that price level, fewer stocks above the 20-day moving average, and therefore fewer participating in driving that index price action.
Right.
Right. Okay, that's one thing, and the other thing, there was some discussion Wednesday night. People were asking about, on our early warning alert, signals, when do you get in and how do you determine that? After that Wednesday night presentation, I received a private email from an EWA subscriber, and I don't know if that person is on the broadcast right now or not. If you are, you'll know that I'm talking about you and thanking you for your observation. But what he shared with me in terms of entries on these EWAs, if you look at this chart, you'll see that when things get pretty oversold down to around the 15, 20, 25 level, once the price starts to bounce, you'll see a pretty large green candle coming off the bottom. And this week here, that candlestick on this chart would have happened on Tuesday. And so this person entered the market, observing that near the close on Tuesday, once he had that particular confirmation for him or herself. And, the same thing, this person did the same thing in May when this got down to around 25 or so in mid-May, and then put in a very large green candle the day after, and entered the market, near the close of that particular day.
Right.
And, had a profitable trade. So that's something I had not paid attention to before.
Right.
I've gone back and looked only about a year or so at, when things have gotten to these oversold levels, and there's only one instance where that really didn't work out so well.
Okay.
All the other ones worked out, perfectly well. And for those who are wondering, well, how do you determine when you want to get into these things when they're getting that oversold, down in that area? That might be something to look at to determine what your entry trigger should be.
Yeah. And so no, that's absolutely awesome, Mike. And I received an email that I haven't shared with you yet from a person who was talking specifically about something very similar. And what they did instead is they just basically took the clues off the breaking of the 8-day moving average, and based on the actual active trend trading system rules, and they too had a very profitable trade. I think they traded 2 times, made 5% each go, and so they were very happy with the situation. But you just brought up something that just hit on me. Is you're absolutely right. When this indicator was up here over 80, the SPX was at or slightly above 2100, and here we are. Less stocks participating, but the S&P is also back up towards the 2100 level. So in a way, that's a type of divergence.
Well, what that tells us is that fundamentally, the breadth across the market that should be required to make this, rally sustainable.
Right.
Isn't there.
Right.
It's a narrow rally. It's probably a handful of relatively influential stocks that are driving the indexes, which we've seen numerous times before and commented upon, and it's telling us that we probably have a very similar situation going on now when you start looking underneath the hood of the market, so to speak.
Right.
That's happened before. I mean, the breadth just isn't there. And if you want the rally to hold and keep going and go on to new all-time highs, you really want to see more stocks participating than what these charts are showing us.
Yeah, right on. I agree wholeheartedly. And so this longer-term chart, basically, yes, we finished the end of the month, and so this is the tick mark right here for the end of June. And as you can see, as of about 9 o'clock this morning, it popped up a little bit. Price action on the spiders, which is reflected in this reddish colored line up here, it's still doing what it's done for the last, well, gosh, going back into mid 2014, where we're operating between this zone, and this zone. Again, this is a monthly chart, so please remember as you watch it, and I will just remind everybody that the top of this tops out at about 211-ish, 212-ish, and the bottom of it is down here at about 185. And so this, you can go to barchart.com, and it would be kind of fun to look at this on a weekly chart. Maybe I'll put up a weekly chart next week rather than the monthly, Mike, just to see how it's operated down here. As you can, and that, but anyway, there's basically our trading range, and until that trading range is busted in either direction, it's tradable in that trading range. It's a very nice wide trading range, but as far as a sustained move at this point, and at this time we're in a sideways market, and are continuing to sideways. And so to Scott's earlier comment about go with the the bullish side, this chart right here tells me we're in a sideways trend, and so we want to be looking for, when it gets up towards the top of the channel, look for downside trades, and when it gets up towards the bottom of the channel, which is in this case about 190 to 185, is look for bounce trades from here. And so that's kind of the plan going forward. So comments? Mike, you still there?
Oh yeah, I'm here. I'm just watching you and listening.
Yeah, I mean, basically we're just, price action is contained. And for the uptrend to really significantly continue, we've got to take out this 212, 212 level. That would be the
for the S&P, I think the high is like 2130 or 2132 or something like that. And for the uptrend or for bullish, market confirmation, that 2132 level needs to get broken. It needs to get broken decisively, and it needs to hold. Otherwise, I agree. You're in a sideways range here. We have been for, gosh, anywhere from a year to a year and a half.
Yeah.
I mean, when you think about it, got up to around 2060, 2070,
right,
like over a year and a half ago, and we're practically at the same level now. And that kind of that kind of sideways consolidation, whether it takes a couple months or whether it takes half, after the big long run-up that we've had off of the lows in 2009, is very often a process that any market goes through, not just the stock market, but any market, as it's topping out and getting ready to retrace a portion of those gains.
Yeah, and that would be, and just to let everybody know, that would be the gains from down here, 2009 up to now.
Yeah, yeah. So you look at that, and you look, charts, similar charts, going back through history, and that sort of sideways. Markets don't hit a top and fall out of the sky. They around for a while before they start retracing some of those gains. And again, we know historically with the U.S. equity markets, it's perfectly normal bull market gains to be retraced to a certain extent. In the bear market, that is bound to.
And so, Gary just basically said, if the Russell is a leading indicator, then can we position ourselves based on that? That's a great question. And again, Gary, I go back to one of the initial comments that I made, was that while we can be aware of what may be shaping up, we still have to trade the charts that are in front of us. And even when the Russell was showing its weakness last year, there were still some nice little upward trades in the Russell, but it was the S&P and the NASDAQ that was really providing the momentum of continuing to push higher, or at least finish higher last year than not. And so even though the market has been in that sideways sideways trend, it still has provided those tradable rallies that were very significant. And so here's where we were sitting. I'm going to get to the stock charts. Here's where we set as about 9:30 this morning. The market was up about not quite 3% from where it ended last week. Same thing on the S&P. Same thing, and each one of these is up about 3%. Russell's up about 2% from where it was last week, but it's still, you got to also recognize these are still down from the highs that were hit back in 2015. Now let's take a look at. So here we have the S&P daily chart on the left, weekly chart on the right. What's absolutely insane, this has been one of the quickest moves. If you look back in here, this move over the last 2 weeks, this goes back to the when. First, let me see if I can open this up just a little bit. And as you saw, we back in December, we got this big move up in 2 or 3, 4 days, and then a reversal down off of that. Same thing here towards the end of the year, and then we got into the stronger reversal. Well, the question as we come into today is, as you can see, long tail on top, price action had pushed back up into this resistance level that runs from about 2100 all the way up to the highs of approximately 2135, and at this point appears to be putting in a shooting star formation, which is a bearish reversal signal. Is it a reason to act at this time? Mike, is this a reason to act? Mike?
I'm sorry, I had a call on my cell phone and had myself muted there, so I apologize. I did not hear your final comment there.
Okay, well, yeah, what I'm saying.
Maybe you're looking to follow up.
With a potential shooting star shaping up for today on the S&P, and since this was such a rapid rise up into resistance zone, is a shooting star today a reason to act on the S&P? Is it a reason to look for a potential downside opportunity?
It's a really good question, and my feeling on that is, I don't think anybody who's on the right side of a sanity check wants to short this market.
Yeah.
Because you're basically shorting the central banks if you do that, and that has proven not to be a very prudent thing to do over the past couple years. However, again, we're getting price action away from the moving averages here to the other extreme, and we're getting a shooting star, and we've had a very rapid advance on very relatively little volume and with little breath behind it. And for anybody who got triggered into going long here, with the early warning alert notice, I'd probably be taking that profit. If you haven't taken it yet, you probably should be taking it today. Be thankful that you made a good move and you made some money on it, and then wait for the next setup, whatever that setup happens to be for you.
Exactly. And because Mike and I were looking earlier, and this is from here to here is basically over a 5.8% move. I mean, that's
like 3 days.
In 3 days.
It's like the sell-off, this whole Brexit thing, and everybody was all shaken up about it. It's like it never happened.
Yeah. And here is the 1st of June, and prices closed right at about $20.99. And so if you take this across to the end of June, as you can see, it was basically unchanged for the whole month of June from start to finish, but you get all of this action going on in there. And so, you know, rather than a portfolio building type market, I definitely think it's a trading kind of market right now, trading between extremes.
Yeah, and without even looking at a monthly chart, you know, just that kind of price action on the daily chart and
right.
the observation you just made, anybody looking at this should know that if you pull up a monthly chart for the month of June, it's going to look like a hanging man candlestick at resistance or, you know, near a top. And we know what the potential implications of a hanging man candlestick are.
Right, right.
Near a top, right?
And so, yeah, because that's exactly what it is. And so, you know, what are the expectations? One is over the last, month or so, the 820 combination moving average has worked kind of okay, but it seems like the market is starting to move into an environment where they don't matter as much anymore. It's done that several times, especially you look at the charts earlier in 2015, where just daily moves. I mean, the 20 and we'll go back and look over here. This was the end of 2015, as you can see, where you would anticipate something, you know, stopping at one of these moving average, slice right through, hit the bottom of the Keltner, pop back up, slice right through, no, hardly a stop at all, got above, drop back through, and again, slicing through that like butter. And so it to me, that is basically say that we're just moving into an environment where expect some volatility. You know, one thing a person can do if they think that, you know, hey, we're going to reverse down off of this, go to the spiders, and, you know, you could do a credit spread on some puts, or correction on some calls, and at least by doing that, your risk is defined. You know how much you're risking, and I always want to try to get at least a 1-for-1 profit loss ratio on those. And one of the other charts that Mike and I want to bring up right here on the S&P is one that is the quarterly chart. And as you can see, this is a quarterly chart that's going back to, you know, a long time ago, back in 1975. It was a very good year. And this quarterly chart goes with a chart that Mike had provided earlier that talks specifically about two different points in time. One was the top here, second was the top here, and it had identified early, and we think we started talking about that in about January of about October, November, December last year, and where it was appearing as if this was going to be same shape as this over here. And the key point on that was, Mike, if I remember correctly, is that when there was a break, a trigger on the MACD in those past times, that it tended to resolve to the downside. And as you can see, so I know you
are. I remember bringing this to your attention. We went over it on one of the Wednesday night webcasts. You know, I read it somewhere else. I saw it somewhere else. I certainly didn't make it up. But I thought, you know, with that MACD indicator, I mean, how interesting and how predictable those crossovers have been on a quarterly chart. And, you know, keep in mind, each candlestick here represents 3 months, you know, 1 quarter's worth of price action. Because of that, the chart moves very slowly, and so the crossovers tend to be a little more reliable. And, you know, we've had this crossover here on the MACD was put in like in the middle of last year, the middle of 2015, when that went negative, at the end of the second or third quarter, I think, of 2015.
Right.
And it certainly hasn't reversed itself yet. And so as we've had consolidation and price action for the last year, and this very strong resistance right up around 2100 to 2120, the momentum's been doing nothing but coming out of things, and we also have, this very apparent divergence in the TSI on this thing. So I know when we looked at this a couple months ago at the completion of the first quarter, and we had, all the upper little wicks on the candlesticks and the hanging type candlesticks.
Right.
And we looked back at past, tops on the chart back in, 2000 and, 2007, 2008. It was looking pretty similar.
Right.
Although it's a lot more. It's been playing out over a much longer period of time this time. And then at some point you get that MACD crossover, and things go through their eventual correction. And we've got the same setup happening here yet. We just haven't seen the follow through.
Yeah, because basically when we first started looking at this, we were about here, and we got that candle there, and then basically, but rather than following through, it started to sell off, got to the 1800 level, and bounced. And this is that 1800 level I was chatting with you about. That's the lows on the S&Ps, and up here in the high level is about 2130. It's being maintained those. And so what's really, I don't want to use the term humorous, but this really depicts that thrust up, thrust down that's been going on and happening. This is basically on a quarterly basis, and so we wanted to bring that to everybody so they could know exactly, are we still under the umbrella of a potential rounded top? The answer to that is yes, and we'll continue to be under that until we get a close back above this 2130 level. And I'm just watching. So I hope you find that interesting. Let's run on over to the NASDAQ. Okay, the NASDAQ. What high low did I take here? For those of you who use Fibonacci's, this is a great example of the NASDAQ on how to utilize these Fibonacci's. One is the 1236 and the 1618 retracements seem to be like magnets, and once they come into play, kind of draw the prices down to them, much the way the moving averages do also once they get overextended. As you can see here, price action on the NASDAQ on Monday actually stopped at the 138 extension and then started moving back up. And as soon as we break through that low there at 2475, you could think of that as a shakeout plus, a shakeout type of move. And sure enough, now we're bounding back up. Now price action got up here, and if I take this out, remove, and we go back in and just check this most recent move, which is from here. Oh, not that one. Have to use the proper, there we go, from here to here. As you can see, price action got right up, kind of delayed at it popped up to the 38.2, gapped above the 50, kind of slowed down at the 618, and then now has resulted in basically blowing through this level. Didn't quite get a complete 100% retracement. If the price action reverses and takes out that 786 fib extension, then we can anticipate that would be a sign of weakness, that we can anticipate that we may continue to fall back down at least to the bottom of the Keltner channels. So comments on, let's remove this drawing. Let's take a look at some of these other indicators. As you can see, even with this big move up, the TSI has not breached the zero line yet. The momentum just barely breached it. The TSI on a weekly chart has turned back up, and this is where you can utilize these these oscillators to draw in pattern lines, like either there, or you can either take this one here and just connect the two highs, and we can anticipate price, and also we've got this trend line here, but as long as price action, or the action on this, the TSI stays below this level, that's telling us that, okay, we're going to probably continue with weakness. If it breaks above it, that can be a cumulative clue to say, oh, okay, we're going back into a stronger market. So we shall see what happens with the NASDAQ. Also, putting in a shooting star type, yeah, Mike?
Oh, I was just going to say, and I think, Dennis, before you get away from the NASDAQ daily chart here, you probably already know what I'm going to say. But going back here to early to mid-April, with the NASDAQ, we put in a pretty good, pretty strong high, had a little bit of a sell-off, a correction down to a low.
Right.
Came back, rallied up to a lower high.
Right.
And as of the Brexit sell-off, we've come back down to a lower low. And despite the the fury and the magnitude behind the past 3 or 4 days here, all we've really done is come back and rallied back to a lower high.
Right.
And that one of my definitions of a trend is lower highs, lower lows, or higher highs, higher lows. And what we're seeing here on the NASDAQ, going on for a good 3 months now, or nearly 3 months, is lower highs and lower lows so far.
Yep. And yeah, and that's a big point, Mike. And the other thing for folks to remember is, I hope that folks were on the training on Wednesday night when we talked about Keltner channels and the moving average envelopes. Isn't it amazing how the price action, here as we hug the Keltner going up, once we find when the correction came down immediately to it, and that goes to that issue of 80% of a stock or an entity's price action tends to be contained by the Keltner channel. When it gets back up to the top, if it busted out and stopped about the 20 or maintained above the Keltner, you would anticipate that being the start of a new uptrend. However, in this condition, it stopped above it, but that was the clue, failure to make a new high, and then of course, last weekend was the rest of the story. And it dropped way below it, and the other thing that it can give you a clue about is that it dropped way below the Keltner, which meant it was way extended away from its 820 EMA moving averages, excuse me, and it was way extended and needed to revert back. So we'll see how we finish off today. Right now, it's working on a shooting star pattern and has not completed yet. Mike, can you talk about the Russell real quick? The reason why I have to do a quick pause. Be right back.
All right. Well, I don't. I don't see anything really happening on the Russell chart, either daily or weekly. We haven't seen on the other charts. A series of lower highs and lower lows, a nice retracement on the fibs that Dennis has drawn in here. Looks like we're very likely to put in a shooting star candlestick on the daily chart for the day today. And I really don't have much else to comment on this chart that we haven't commented on already on the other charts. And unfortunately, I'm not in a position to take questions or comments from anybody while we're waiting for Dennis to get back here. So I don't know what else to go on. I think maybe we'll just take a little pause here until Dennis.
Okay.
And sounds like there he is.
No, go ahead.
No, I think I'm done.
Okay.
Unless anybody wants to pose a question or a comment on what we chatted about for a moment while you were away.
Okay. So I'm sure you covered that exceptionally well. And that could almost be a Tombstone Doji setting up.
Okay. All right. I didn't think of that terminology, but yeah.
Yeah. So cool. Okay. Then where we go? Where to from here? And yeah, this is a good indication how that that Russell chart looks a lot weaker than the other two indexes. And so, David says sell the SPY 950 calls. Yeah, David, that might be a good call. I was looking earlier this morning at the 210s for next week. And so anything I can get around $1 worth of premium out of it, that's what I'll be looking for. So, okay. So leaf, the path of least resistance, Mike, we've gone over this several times. Longer term, it appears as if the path of least resistance is going to continue sideways in a really significant range. I think we have hit the height of and so on a shorter period of time, I think the path of least resistance maybe going into next week or maybe through the whole part of July will if it follows the historical norm or 70% of the Julys over the last 10 years being down for the month, I would anticipate a potential downside as the path of least resistance. How about you, Mike?
Eventually, I agree.
Okay, cool. Long term, it's kind of sideways, but in a tradable range. How are we doing? Let's see. Okay, here's where we finish off the month. Those of you who did the gold spread trade, we were able to, we hit T2 this morning, closed the position out for a little bit of over 100%, for a little bit over 100% gain on that piece of the puzzle. We started pushing when we added the Tesla positions, the additional Tesla positions to the strategy 3. It really kicked off and increased our strategy 3 collections, even though I got whacked with a double dip hurt on the spiders this week. And I really...
Hey, before I check out of here, did you read the news, the recent news about Tesla?
About the test driver being killed?
Yeah, I don't think he was a test driver. I just think he was a regular, guy. And, the Teslas now have autopilot or auto drive, and he had his autopilot on and apparently was watching one of the Harry Potter films. Teslas have pretty big screens in them, and the car ran right into a trailer truck.
Oh, wow.
And he was killed. Yeah. And even in this market with that kind of news for the day.
Yeah, well, it sold off after hours, but then rebounded, and I'm just going. I was not saying nice words after it rebounded, but I didn't quite close the gap on my June. I was really working hard to close that gap. Well, we did close it a little bit to get our equity curve trajectory back up towards this 40% gain for the year that I shoot for. So we closed the equity gap a little bit, worked real hard in July to try to close it the rest of the way. I would like to see by the end of the July either being at the equity curve and or above the equity curve. And so pretty good trajectory moving forward. And we've talked about the Tesla trade before. The Tesla trade, at least the first half of it that we put on in September of last year, we're really closing in to getting, collecting our 100% profit on this. We've already paid for the position, and our cost basis, which was $90.10, our cost basis is now a negative 36.34, which means we have more than paid for the position. If you want to learn more about these strategy 3 trades, you can check it out here at the website. And here's a trade we started 2 weeks ago on about the week of 6/24. We went long, and this was a seasonality trade on gold. We did a long spread out, we took it out here January 17th, and we bought the 122. This was a debit spread, bought the 122s by 127s for $1.49. That Friday we entered here. That Friday we were able to close, and the move happened too quickly, so that the didn't have enough time for the time delay to really take effect. So we went ahead and closed, since we'd hit the price target, we went ahead and took out the one of the, a quarter of the position, sold it for, bought it back, or sold it, sold it for $2.50, a gain of about $67, and then we get the gap up today, and it's so nice in the morning when you've got your order already in. I had an order in to sell at $3 and another quarter position, and it was hit this morning and actually sold at $3.10, which is a 108% gain. And that was on 7/1. The rest of my target between now and August 17th is to take out the remainder of the position at between $4.50 and $4.80. And so far half the position has been paid for, and actually just about paid for the underlying. So it's from here on, it's more or less a free trade. So this month, the July BAM meetings in San Jose will be webinars, and they start next Tuesday evening. And so for everybody who's a subscribing member of the BAM with paid dues will be invited to that. We'll have another one later in the month. Lyle is going to be helping us do some presentations on some psychology stuff. Then training every Wednesday night. This week we're going to be talking about selling option premium for profit. And then I'm still putting together, trying to get moved into our house over here in Hawaii, and still trying, but I'm putting together this How to Trade Strategy 3 so that you can, as a standalone training. And so if you have a group, as I'm driving around the country come August, would love to stop in and say hi. And the places we're going we're going up into Washington State, we're going across to Boise, Idaho, we're going down to Cheyenne, Wyoming, down to Denver, down into Arkansas, and then we'll come back through Texas, and all points in between. So that's where we stand on that. Let's see. We want to remind everybody that, if you're tuning in and just listening to recording of this, the Active Trend Trading System, we try to focus and keep it clear, simple, so that you can multiply your account. We basically cover what to trade, when to enter, when to exit, what strategies we use, and what our expectations are. I'm a firm believer in too many people trade strategies, but they do not have a solid core system to trade off of. The Active Trend Trading supports each one of our 3 strategies that we trade. And so with that, have an absolutely fantastic 4th of July weekend. And thanks for joining us a half hour early. The reason I wanted to start a half hour early is I was really squeezed last week to get out notifications by only having a half hour before market closed. So with that, I have time to look at a couple of stocks. And so if you have something you want us to look at, what would that be? I want to take a real quick look at Tesla to see how it's doing. Okay, Tesla's rallying. So if you were short that call position, we'll probably take a loss on that and just hold off till next week to re-enter it, although I'll probably wait until right at the absolute close to take care of that. See how gold's doing. That gold trade has broken up, and we don't know at this time whether this is a breakaway gap. We had a nice gap up here, gap up here. And this is another thing on the market. Typically gold goes up when the market's going down. And so there's a lot of mixed signals out there. Come visit us in Dublin. Yeah, deeper. I will be back in the Dublin area in the July, and then the July, first part of July, August, and then down into September, because we'll be staying up with Brandon and Sharon up in Marin County. So let's see, what else? ERX. Okay, ERX is, what is ERX? Okay, Energy Bulls. And it looks as if it is really, kind of take off. It's got an real nice initial move up. If you were with us on one of the Wednesday nights, watch this pattern here, because this pattern is appearing like it's one of those sideways patterns where it's basically just trading within these ranges from the bottom Keltners and moving average envelope up to the top of them. It's approaching the top of it, and so it's going to have to break out above that if you're going to take it long, or the other place to take this long would be on a pullback back into this area. And so, and oftentimes, if power is coming back into a entity, it'll come up here, hit the top of the range, come back, but then rather than continue its fall to the bottom of the pattern, it'll stop about half to 2/3 of the way down and then spring load up. That can be an initial clue to let you know what's going on and that it's going into a significant uptrend. So I've got time for, so a profit top of 32. Yeah, about, Dorothy. Was it you who asked me about that? Okay. And so you also asked, would a $1 trailing stop be too tight? I don't think so, simply because this is, it's average, average to range for a day is about $1, $1, $1.50. So if you're trailing down here, that would not be too bad. 32 level would definitely give you a reason to at least take off some, anywhere from 30, probably 31.50 on up would be a reason to take off some of your profit. And let's see, plow. Okay. Okay, this stock does not trade a lot of volume. It's got about, I would normally not look at this because it's not above 500,000 shares per day, but it may be running into its exhaustion. It's putting a shooting star here. Wait for a pullback, and the pullback will take in the shape of either pulling back into the 820 moving average range, which may be down here about 25, or even down here at 23.50. As you can see, it has broken out to a new high over here, and so we'll see if that can be maintained moving forward. And WB, basically it has, got pretty good average volume of a little bit over a million shares. It's, as you can see with this latest move, it's moved back up to the top of the Keltner channels, or towards the top of them. The volume has kind of dropped off a little bit. And so it has made it appears on a weekly chart that it's moving to a new high. And a breakout to a new high. So it's going to digest those gains. It looks like it's digesting between the 26 up here to the, almost 29.50 level. So last one, IBB. You know, look how much this looks like the index is, Gary. It's almost made its way back up to the 50. It had made a new low, but it is just basically continuing to trade. Take a look at this on a longer term chart, weekly chart. Yeah, it's got a nice little trading range, 240 up to 289. And so if I were looking to get in it now, I would be waiting for my pullbacks to the 8 and 20-day moving averages, or for it to put in a nice little flag. If it flags down, pulls down, kind of like it did over here, ran up and then ran up, stopped, flagged down, then refound itself and went higher. So same thing kind of here. Somewhere started just a little bit of a flag down, hopefully hit the 8-day moving average, and then watch for it to spring off of that. If it reverses and doesn't spring, then that can be indicative that of more weakness than we would like. And so, yeah, it is, but Barry makes a statement that it seems like lower lows and lower highs. And I would say in the context of from here to here, you're absolutely right. But if you look over here on the weekly chart, it basically shows that it's more in a contained trading range. In that larger term, it stopped its lower lows here, ran up, made a short-term swing high, came back down, retested, reacted up, thrust back down, and it's now bouncing off of that level of support. What happens in this area, right here in this midsection area, will tell us where things go from there. So, okay, folks, with that, we're going to call it a day. And thank you so much. Have a great 3-day weekend, and we'll chat with you next week. God bless everybody.